Welcome to 3 and 3. Today we're going to be talking about job-full recession, market bifurcation, and bond duration. Job-full recession. So one of the primary data points the Fed is looking at is the labor market, which has been especially strong during this entire hiking cycle, making it harder for the Fed to tame inflation. The common view is that we need a recession in order to bring inflation down, and that we cannot have a recession with such a strong job market. The current rate of unemployment is 3.7%. And generally speaking, an unemployment rate below 5% is considered to be full employment. So over the next 12 months, the unemployment rate is projected to rise slightly, but stay below the 5% rate. So again, giving us potentially a job-full recession. So as you look at the gray bar, you're looking at previous recessions. The 2000 to 2002 recession, we had a rise of unemployment. And also during the Great Recession from 2007 to 2009, another dramatic rise, actually, in this case, of unemployment. We're expecting in this situation, assuming we have a recession, that we'll have a slight rise and that we may stay below the 5% rate and again have a job-full recession. Market bifurcation. So market bifurcation is a term used to describe the phenomenon of two different asset classes. During periods of uncertainty, investors may become more risk adverse and move into value stocks. And during periods of expansion, they may actually add risk and go into growth stocks. In 2023, growth stocks have significantly outperformed value stocks, even though we're projecting a slowing economy. But market data suggests that during recessions, that value tends to outperform growth. As you're looking at this chart, you're looking at the orange bar or orange graph, which represents the growth ETF through Vanguard, which is up over 31% year to date, and comparing that against the value ETF, VTV, through Vanguard also. And you can see that growth has outperformed value by over 30% year to date. Bond duration. So bond duration is a measure of how sensitive a bond's price is to the change of interest rates. The higher the duration of a bond, the more sensitive it is to changes in rates. If you had an increase in interest rates and you had a longer bond duration, you would actually have a more significant drop in your bond price. And conversely, currently, shorter duration bonds, less than 1 year, have benefited from rising interest rates, as the Fed has raised rates over 500% over the last year. As the economy slows, longer dated bonds have historically outperformed and they've definitely outperformed during recessions. This is because they are considered to be less risky than stocks, and some people maybe use them as insurance as the stock market becomes more volatile. As you can see from this graph, that short-dated securities have higher interest payments than the 10-year or 30-year bond. If we were to enter a recession, as we're projecting, the Fed would start to lower short-dated securities. Potentially then, those longer-dated securities would start to come down in yield also. If you had a 10-year bond and interest rates were to come down, you would have a high return on those bonds as the prices would go back up. Thank you for joining us for 3 and 3.